All right, let's dive right into this explainer. If you've ever just stopped and looked at the sheer volume of global commerce, we're talking millions of companies trading, building, and selling every single day across borders. You really kind of have to wonder, how do we keep all this from just descending into total chaos? Well, today we're going to unpack the ultimate rule book of business. We'll see exactly how it creates trust, uniformity, and literally forms the bedrock that holds the whole financial world together. So it brings up a huge question, right? How do we actually make sense of business? To wrap our heads around all these incredibly complex transactions happening globally every second, we absolutely need a universal language. I mean, think about it. Without a shared dialect, how is an investor sitting in Tokyo supposed to genuinely understand the performance of a manufacturing plant over in Toronto? They can't. Not unless they have a non-negotiable set of rules to accurately keep the score. And hey, keeping score here, it isn't just some clever metaphor. It's the literal foundation of modern capitalism. It's about cross-border communication and absolute reliability, because without it, global trade just stops.
Which brings us to Section 1, the framework of trust. So accounting principles and standards provide this exact framework. They're basically the underlying concepts, conventions, assumptions, and rules that govern everything a business reports. And the crucial thing here is that these standards exist for one overarching reason: to guarantee absolute uniformity and clarity. Just imagine if everyone just made up their own personalized concepts to measure success. Investing would literally just be gambling. Comparing two companies would be like trying to compare miles to kilograms. Totally useless, right? But when everyone follows the exact same concepts, we can instantly and confidently compare the financial health of completely different organizations, even ones in entirely different industries.
All right, let's move into Section 2, setting the boundaries.
And this brilliantly illustrates the entity concept. Basically, the rules demand a strict, clear brick wall separating the business itself from the personal affairs of the owners. In the eyes of financial reporting, the business is a completely standalone entity. It's almost like its own person. So, if a startup founder goes out and buys a flashy personal sports car to cruise around in on the weekends, that transaction simply doesn't go on the company's books, period. This clean, non-negotiable separation is absolutely critical for protecting the integrity of the data. It completely removes the owner's personal finances from the objective reality of the business.
Now, alongside the entity concept, the rules lay down two more foundational assumptions to basically set the board for our business game. We've established our separation, sure, but now we have to figure out exactly what kind of information is actually allowed onto our scoreboard and, just how long we expect this game to last.
Well, the money measurement concept is brutally literal. In the strict eyes of financial reporting, only monetary transactions are recorded. If an event can't be definitively measured and recorded in a specific currency, as far as the financial statements are concerned, it simply does not exist. A company could have the most amazing, motivated workforce on the planet, or this incredible industry-leading brand reputation. But because you can't put a definitive, objective dollar sign on a concept like team morale, it doesn't get recorded as an asset. Everything in this framework boils down to cold, hard currency. It might sound a bit ruthless to just ignore those human elements, but really it's the only way to maintain a truly objective, universally understood standard.
Furthermore, we have to address the lifespan of the enterprise. And the going concern concept is pretty much the ultimate optimist of the financial world. It operates on the foundational assumption that the business is going to continue its operations indefinitely into the future. We don't record the numbers as if the company is going bankrupt tomorrow and liquidating everything at a massive discount. No, we record them assuming it's an ongoing, continuous machine. And that's exactly why a business is allowed to buy a massive warehouse today and logically spread that cost out over the next 30 years.
Okay, let's shift gears to Section 3, the mechanics of recording. This brings us to a highly pragmatic rule, the cost concept. When you acquire an asset, you absolutely must record it exactly at its acquisition cost. So if your business bought a piece of heavy machinery for $50,000, you write down exactly $50,000. This intentionally removes all subjective guessing from the equation. Even if you swear that machine is worth twice as much today because of inflation or because it's super rare now, you do not inflate the number on your balance sheet. You stick strictly to the verifiable historical cost. By cutting out all that wishful thinking, this rule keeps the books firmly grounded in reality.
But the absolute magic of keeping score, the true engine of all financial reporting, really comes down to the number 2. Honestly, 2 might just be the most important number in this entire explainer. Let's look at why.
The dual aspect principle is what underpins all double-entry bookkeeping. This is a genuinely brilliant system. It was popularized by Venetian merchants and famously codified by a mathematician named Luca Pacioli way back in the 15th century, and it quite literally built the modern economy. It ensures that for every single financial action, there's always an equal balancing reaction. If your company takes out a bank loan, your cash goes up, right? That's one aspect. But your debt also goes up by the exact same amount. That's the second aspect. This beautiful dual symmetry guarantees the system is always in perfect mathematical balance. It's a built-in self-checking mechanism that literally makes the massive scale of global commerce possible today.
Moving right along to Section 4, controlling the clock.
So, the accounting period concept essentially solves the paradox of measuring a business that theoretically lives forever. It chops that infinite lifespan up into clear, defined time segments, kind of like innings in a baseball game, so we can actually measure profit and performance. Whether it's a month, a quarter, or a full calendar year, we basically put up artificial stopwatches. By pausing the clock and looking only at a specific, isolated segment of time, stakeholders can accurately gauge performance, course correct, and make those necessary adjustments before it's too late.
And to make that profit measurement perfectly accurate within those specific time segments, the matching principle steps in. This rule guarantees that revenues and expenses are matched perfectly side by side within the exact same period. For example, if you sell a massive order of products and earn revenue in December, the sales commission you incurred to generate that revenue absolutely must be recorded in December too, even if you don't actually write the check to pay the salesperson until January. You can't just delay your expenses to make the current month look artificially profitable. Everything has to logically and chronologically align.
Finally, let's wrap up with Section 5, the ultimate bottom line.
When we bring all these pieces together, we get a completely airtight rulebook. By strictly enforcing these concepts, from separating personal affairs with the entity concept to matching revenues and expenses in defined time segments, financial reporting works a literal kind of magic. It transforms what is honestly a highly complex, often chaotic economic environment into a unified language of absolute clarity. It's a system built entirely on these conventions, ensuring that our investor in Tokyo and our manufacturer in Toronto are looking at reality through the exact same reliable lens.
Which leaves us with one final, pretty provocative thought to ponder today. We've just mapped out exactly how these standards guarantee trust and allow the modern world to actually function. But if these specific concepts are the only framework ensuring uniformity across the entire global economy, what happens to a business or even an entire market that decides to just ignore them? Think about that. Thank you so much for joining me for this explainer, and I really hope this helped you decode the fundamental language of business.